we're very much positioned for it, but we will benefit even greater from the turbocharging that's going to come from AI over the next decade or so.
Hello, you're watching Proactive. Joining me in the studio today are Cordiant Digital Infrastructure Management Chairman Steve Marshall, as well as CFO Andrew Ewe. Thank you both very much for coming in. Good to see you again.
Thanks very much.
So Steve, I'll start with you. Your first quarter update shows EBITDA up nearly 10% on the prior comparable period, strong dividend cover. Do you see yourselves as a growth company, especially now that you've delivered close to 4 years of consistent, strong results?
Stephen, I certainly hope so. For the last 4.5 years, we've been delivering good growth and yield right over that period of time. Just under 11% growth and yield over that period of time. We follow a buy, build and grow strategy. So we buy really good quality assets. We look to support the management team, grow them and invest in the business as a result of that. And we've shown that very successfully over a number of years. We are very much in the digital infrastructure space, which is sort of mobile towers, it's data centers, it's fiber optic networks. And as most people will recognize, those particular subsectors have the wind at the back. They're growing sectors. There's more demand for capacity across the network. So of course that gives a growth trajectory for us. And these companies that we bought have really great strong brands. They have a good competitive moat. They have blue chip customers. They want long-term access to our assets, whether it be fiber, whether it be towers, or indeed in the data centers. And because of that, of course, we want appropriate protections against inflation. So we want escalation clauses. And what that results in, of course, is a very consistent growth in cash flows and revenues and profitability over the long term, which drives that growth that I've been talking about, but also allows us to give a yield. So yes, I would say we're a growth company, but we're also delivering yield at the same time to our investors.
Andrew, can you walk us through the key drivers of the growth in EBITDA in the first quarter?
Sure. So we had 9.6% EBITDA growth this quarter, year over year. So this is underpinned by good revenue growth of 9%. So as always, generally, we benefit from inflation, which feeds through to index-linked contracts. Highlights include Emitel, which is having very good growth in its mobile towers division. So currently building out mobile towers for mobile network operators in the country, such as Poland. And it's also benefiting from contracts it signed last year in both the radio and TV broadcasting space. Elsewhere in the portfolio, CRA is having another year of growth from its broadcast contracts, both TV and radio, as well as growth in its data center and cloud division. Revenue-wise, growth was a bit more modest, but revenue growth typically is not linear throughout the year. And finally, with Speed Fibre, also growing revenues just over 3%, despite a challenging fibre market currently in the country. Elsewhere, we're benefiting from the addition now of Data Center United in Belgium to the portfolio. And cost-wise, there's been good cost control, so we're on budget at the moment, EBITDA-wise.
How do these latest results impact your capital allocation policy and your approach to leverage?
So I'd say these results do support our current capital allocation policy. So we strive to maintain a balanced approach with a progressive dividend and capital appreciation for investors. So dividend coverage today remains at 1.7 times. So we're on track to deliver the 4.35 pence per share dividend we announced at the latest results. Going forward, we continue to maintain a prudent balance sheet. So leverage is just under 41% of gross asset value, well below the target we set ourselves at IPO. We'll look to use any additional debt judiciously to invest in growth projects, which will deliver above average IRRs for the portfolio. And today, we just have over £200 million of liquidity available to fund new projects.
Steve, as Andrew mentioned, portfolio companies have made progress on several initiatives. So from CRA's Prague Gateway data center to Speed Fibre's acquisition of BT Ireland, which of these projects do you see as the most meaningful near-term value drivers for shareholders?
Steve, these are two incredibly fantastic projects. If you start off with BT, because we've just completed that 3 weeks ago, we're actually taking joint number 2 players in the marketplace, Speed Fibre and BT. We've bringing them together. We're merging the asset base, the services, the products, and indeed the management teams, and that will create a very strong number two to the incumbent Air in Ireland. And it's great to see that we'll be able to offer much greater benefit to both our wider customer base now, our existing customers, and those customers that come across from BT. And also, it's lovely to see and welcome the BT employees joining the family of Speed Fibre Group and Cordiant. Great talent there that will be merged with our existing talent, and I think quite eager actually to take on the great opportunity that we now have with this much greater asset base and product base. So very happy and very pleased with that opportunity. And then Prague Gateway, CRA have done a fantastic job in building a number of edge data center properties in the Czech Republic, probably the leaders in that field now in the Czech Republic. They've built great credibility amongst a wider customer base. They've actually acquired and expanded their cloud service facilities and wider services. And as a result of that, they felt very confident in repurposing an old site that used to hold AM radio towers to secure all of the permits that are needed to be able to build a 26 megawatt data center in the Czech Republic just outside Prague. And they're already clearing the site now to make it ready for construction. And when that's built, it will be the biggest data center in the Czech Republic. It'll be state-of-the-art facility, and quite interesting actually. As a shovel-ready project, the Czech government has actually got behind the project and said, you know, would we be willing to expand it to say 100 megawatt facility, and bid for one of the European gigafactories. So we have submitted that enlarged project to the European Union with the support of the Czech government. And we'll see whether we're successful in that bid. I mean, I think there are 6 going to be built throughout Europe. You know, there's a chance that we could be one of them.
Andrew, despite the strong operational performance, the share price continues to trade at a discount to NAV. What do you think is holding back a re-rating, and what steps can management take to help close that gap?
Thanks. Yes, no, we are very disappointed by the continuing discount to NAV. We don't believe it's justified. It's fair to say this is an issue across the sector in the alt space. You know, that being said, we have almost halved the discount since around this time last year. What we can focus on is what's under our control, so delivering good operational performance and communicating this well to the market. So growing EBITDA, growing the asset base, and in time we're confident that we'll see this come through into the share price. You know, we are pleased to see that out of the 9 research analysts that cover our stock, all of them do have a positive rating on our shares. And I suppose the silver lining to us is that we can continue personally to buy shares personally in the company since the annual results. The management team, Steve, myself, as well as the board, we've acquired almost 500,000 shares in the company. So insider ownership now accounts for about 2.1% of the company stock. So the manager is very well aligned with shareholders in this respect, and I think you know, further underpinned by the fact that the management fees are linked with market cap, which is very unique in the sector.
I mean, as you've been saying, Steve, digital infrastructure remains in high demand, so particularly the rise of AI and increased connectivity requirements. How's Cordiant positioning its portfolio to capture these long-term growth trends while remaining disciplined on your capital deployment?
Steve, we are already very well placed to benefit from the onset of AI. We're in the digital space, we've already talked about. We've got the mobile towers, we've got the fiber optic networks, and we've got the data centers. These are going to provide the capacity that is going to be increased and needed for all of the developments of AI. So not long ago, I was actually talking to an investor, and he was saying to me, Steve, you know, I understand that AI is going to drive the demand for data centers, but are you not in the wrong data centers? Because we are sort of in edge data centers, we're in space and power data centers. I said, no, Of course, people are going to spend billions on building these gigafactories in order to drive machine learning. But when we actually utilize it, when the end customer utilizes it, what are they actually doing? You know, I'm on the phone, I'm using the various open AI services to access information. So if I'm accessing that from my mobile phone, I'm going over the mobile tower communication system, which puts more demand on the network. If I'm doing it from home or the office, of course, I'm using the fiber optic network, it's putting more demand on the fiber optic network. And of course, the companies that are providing a lot of this information are putting more information and servers within all sorts of data centers around the world, including ours. So we're very much positioned for it, but we will benefit even greater from the turbocharging that's going to come from AI over the next decade or so.
Well, gents, I hope you'll continue to keep us updated with your progress. Thank you very much for joining us in the studio today.
Thank you very much.
Thank you.
That's Steve Marshall. He's Executive Chairman of Cordiant Digital Infrastructure Management and also Chief Financial Officer Andrew Yu.